Welcome to Talk Tickers. We're your shortcut to understanding the key takeaways from today's earnings calls.
And today, we're diving into the latest numbers from Quorum Information Technologies. That's their Q4 and full year 2024 report.
Right, so the big picture first. What's the overall vibe from this call?
Well, the main theme seems to be a definite focus on profitable growth. Q4 revenue was up just slightly, full year down a tiny bit.
Okay.
But the profitability metrics, especially around cash flow, they showed some pretty significant improvement.
Interesting. Okay, let's unpack that, starting with Q4 revenue.
Yeah, so for the quarter, they pulled in $10 million total. That's up 1% compared to Q4 last year, just a small bump.
Got it. And how did the different parts of the business break down? SaaS, for instance.
Their software as a service, or SaaS, that segment grew 2% in the quarter, hit $7.2 million.
Okay, decent growth there. What drove that?
Seems like a mix of things, cross-selling more stuff to their existing dealerships and also landing some new clients.
Makes sense. And the other piece, the BDC.
The Business Development Center, yeah. That saw a slight dip, actually. Down 1% in Q4 to $2.6 million.
Down 1%.
But interestingly, even though it was down year over year, it was still their highest BDC revenue quarter for all of 2024.
Okay, so a bit of a mixed bag on the top line for the quarter. Let's talk profit. How did the margins look?
Right, margins. SaaS gross margins stayed strong, 67%, pretty solid.
Okay.
But the BDC gross margin, that fell 5 percentage points, landed at 17%.
Ooh, 17%. Why'd the drop there?
They said it was mostly down to hiring new people and, getting them trained up. Investment costs, basically.
Right, onboarding. So overall gross margin.
Overall, it held steady, $4.8 million, which works out to 48%, same as before.
Okay. And moving down the income statement, EBITDA.
Adjusted EBITDA for Q4 was $2 million. That's actually down 5% slightly, representing a 20% margin.
Down slightly. Okay. Yeah. But you mentioned something about cash flow metrics improving.
Exactly. They introduced this new metric, cash EBITDA, and that number was actually up 10% for the quarter, reaching $1.2 million. That's a 12% margin.
Cash EBITDA. Okay, tell us a bit more about that one. What is it measuring exactly?
So they define it as adjusted EBITDA, but then they subtract specific cash costs, things like stock-based compensation and capital expenditures.
Oh, okay.
The idea is to give, a clearer picture of the actual cash the operations are spitting out.
Got it. So it strips out some non-cash items and capital spending, more of a pure operational cash flow view. Makes sense.
Precisely.
Okay, let's zoom out then. What about the full year 2024 picture? How did revenues stack up overall?
For the full year, total revenue was $40 million. That's actually down 1% compared to 2023.
Down 1% for the year.
Yeah, but if you break it down, SaaS revenue grew 2% for the year, reaching $28.8 million. That's now 72% of their total revenue.
So SaaS growth offset declines elsewhere.
Right. The BDC revenue decreased by 8% for the full year, down to $10 million. That's about 25% of their total revenue now.
Okay, so a clear shift towards SaaS becoming more dominant. What about full year profitability?
That's where the story gets better. Full year gross margin actually increased by 3%, hitting $19.8 million.
Nice. And EBITDA?
Adjusted EBITDA saw a really significant jump, up 18% to $8.3 million. That pushed the margin up to 21% for the year.
18% jump in adjusted EBITDA. That's substantial.
It is. And the cash EBITDA story, even stronger. It surged 89% to $5.5 million for the full year. The margin basically doubled to 14%.
Wow. 89% growth in cash EBITDA.
Yeah.
Doubled the margin. That really highlights the improved cash generation you mentioned earlier.
Absolutely. Management really hammered this point home, that it's the result of their strategic shift back in 2023 towards, profitable growth, not just growth at any cost.
And a big part of that strategy involves their current customers, right?
Exactly. They have over 1,400 dealerships already using some of their software.
And the opportunity there is
huge, apparently. They estimate there's a potential $54 million in additional annual SaaS revenue just from cross-selling more of their 13 solutions to those existing clients.
54 million. Hang on, that's roughly double their entire 2024 SaaS revenue.
That's what they said. Many dealerships are only using one or maybe two solutions right now. So yeah, a massive runway if they can execute on that cross-selling.
That's a key number. Of course, executing is the challenge. What hurdles might they face getting dealers to adopt more software?
Well, dealerships always worry about integration headaches, training staff, the usual friction points when adding new tech. It's definitely not automatic.
Right. Something to watch. They also mentioned they're changing how they report rooftop counts.
Yeah, they are. They disclosed the Q4 count, 1,412 rooftops, down just a tiny bit, 0.4% from Q3.
Okay.
But going forward, they won't be routinely reporting rooftop numbers or revenue per rooftop.
Why the change?
It ties into their strategy. They're focusing more on selling these potentially lower priced but value-added solutions and getting deeper into existing clients rather than just chasing sheer dealership count. So the metric becomes less relevant to their core strategy, they argue.
Focus on wallet share per dealer, not just number of dealers. Okay. So with that improved cash flow, what are their plans? Capital allocation.
They laid out a few priorities. One is organic growth, investing more in sales in both Canada and the US.
Okay.
Second is inorganic growth, so strategic acquisitions to add more products to their suite.
Acquisitions are back on the table then.
Seems so. And third, they mentioned potentially returning capital to shareholders, eventually, buybacks or maybe dividends down the road.
Interesting on the acquisition front. Did they give any hints about what kinds of companies they might be looking at?
Yeah, they did mention looking at some US-based targets, areas like rental and fleet management software, tire storage solutions, and also AI-powered tools for dealership sales and service.
AI is everywhere.
It is, but they also sounded a note of caution about jumping into US deals right now.
Oh, why is that?
Uncertainty around the current administration's policies, apparently. So they're looking, but maybe hesitant to pull the trigger on a US deal immediately. They also said they're building their own AI capabilities internally, too.
Okay, that political uncertainty is a factor. What other headwinds did they discuss? I saw mention of tariffs.
Yes, the new auto tariffs from both the US and Canada. That's definitely a big question mark hanging over the industry right now.
How big of a concern is it?
Well, the details are still fuzzy, like which vehicles, which parts, how high the tariffs will be. But the potential impact is significant. Could mean fewer vehicle sales, pricing challenges, margin pressure for dealers, and the manufacturers, the OEMs.
So how is Quorum positioning itself to handle that potential disruption?
Management sounded pretty confident, actually. They pointed to their experience navigating COVID and the parts shortages.
Right. They've seen disruption before.
Exactly. And they emphasize that their software suite helps dealers in tough times, driving service business, improving sales closing rates, managing margins. They think the fixed ops side service and parts will be especially crucial if new car sales slow down due to tariffs.
So their tools become even more valuable in a challenging market. That's the argument.
That's the argument, yeah.
Okay. One more operational thing. The Q Cloud migration. How's that going? Moving to the cloud.
Ah, yes, Q Cloud. They acknowledged it's been a learning curve. There have been challenges.
Not uncommon with big migrations.
True. They said they've tackled about 80% of the initial issues, but they've actually slowed down rolling it out to customers deliberately.
Why slow down?
To make sure the cloud environment is really stable and fast enough, meeting their standards before pushing more clients onto it. They're still optimistic about the long-term benefits, but couldn't really put any financial impact numbers on it just yet.
Prioritizing stability over speed. Probably wise. Okay, let's shift gears. Time for our This Is Not Financial Advice segment.
Right, the speculative idea zone.
Exactly. So given Quorum's healthier balance sheet, less debt, there's stated interest in acquisitions, but hesitation on the U.S. front. Here's a thought. Maybe a bit out there.
Okay, let's hear it.
What if Quorum looked across the pond? Maybe acquire a leading European electric vehicle charging infrastructure company. Perhaps one that also has a decent software platform for managing charging networks or fleets.
Ooh, European EV charging. That is a pivot. Why that?
Well, think about it. One, instant diversification gets them into the high-growth EV space, less reliant on traditional North American dealerships. Two, maybe it sidesteps some direct impact from North American tariffs, gives them geographic diversification.
Interesting angle.
And three, if the target has fleet management software, it aligns with their stated interest and could even offer synergies back to their dealer clients who are starting to handle more EVs and fleet services.
Okay, I see the logic. Diversification, potential tariff shield, aligns with software expansion goals.
But huge risks. Absolutely. It's highly speculative. Totally different market. International regulations, integration challenges would be massive. They could overpay, misjudge the European market completely.
Yeah, definitely not a straightforward move. A big bet.
Precisely. Purely an idea sparked by their current situation and stated goals. Absolutely not investment advice, just food for thought.
Understood. So, wrapping up our deep dive on Quorum, the key takeaways.
Improved profitability is clear, especially cash generation. Strong focus on that $54 million cross-selling opportunity within their existing base.
Yeah, and deleveraging too, getting that debt down significantly. Total debt to cash EBITDA now just 1 times. That's a major improvement.
Definitely. But headwinds exist, the tariff uncertainty is real, and the Q Cloud migration is still a work in progress. Acquisitions seemed likely, but the timing and geography, especially regarding the US, are uncertain.
So a company in transition, focused on profitability with a big organic growth target, but facing some macro question marks.
That sums it up nicely. What do you think about their strategy? Can they hit that $54 million cross-sell target? How will tariffs impact them? We'd love to hear your thoughts.
Absolutely. Join the conversation. Thanks for tuning in to Talk Tickers.
We'll catch you on the next earnings call breakdown.